This podcast is brought to you by AppFolio Investment Management. In a recent study, AppFolio Investment Management customers reported up to 70% growth in their total EUM over a one-year period. How? They were able to cut fundraising time down by 50%, automate waterfall distributions, and impress investors with an online investor portal. Learn why thousands of real estate investment managers are choosing AppFolio at appfolioinvestmentmanagement.com.
Welcome to WMRE's Common Area Podcast. This podcast is brought to you by the award-winning editorial staff at WMRE. Let's jump right into this week's podcast.
Hello and welcome to the Common Area with your host, David Bodamer. David, how are you?
It's a little bit of a crazy week actually here because both of my parents who are divorced, actually they don't even live together, but both of my parents somehow simultaneously got COVID. So dealing with that, and then also, which is somewhat relevant to the subject that we're going to discuss today, but I found out I'm going to have to move because my landlord gave us 90 days notice. So I've had to unlock this. Yes.
That's no bueno. Yeah. And you certainly can't go stay with a parent right now.
Right.
There's not that to fall back on. Oh my goodness. Well, let's get your mind off that stuff for a little bit and talk about this report that you guys have put together. And I know that you guys do research all the time. So why don't you tell the audience what we're going to be talking about today?
Yeah, so we recently published a brief on the third time that we've done research specifically about investment in single-family rentals. So that's I wanted to just provide a bit of an overview of the results of that.
Okay, so you said this is the third time you've done it.
Yes.
Okay.
Yes. Yeah, and I think the timing is actually important because we did it initially in 2019, so that would have been pre-pandemic. Then we did it again in 2020, so that was kind of I don't actually remember what month we did it, but 2020 in general was obviously the pandemic year, so we did it again, and so this is the first time we've actually conducted it, in what is basically a post-pandemic environment. Obviously we are not really post-pandemic, but at least post all the crazy shutting things down and economy being frozen part of the pandemic. So it's that I think that provided, just given the different times that we conducted this, provides an interesting snapshot of the sentiment around the sector.
Yeah. Well, and I think that investors, whether it's real estate or investors in other things, are all kind of getting really tired of all of us, right? We're getting tired of, we're in pandemic. It's easing off. Oh no, it's coming back. Yeah. And so at this point, I'm going to coin a phrase right here on the podcast. I think it's more of a pandemic. That's just like, it's back. Okay.
Yeah.
So no, I think you're spot on. I think that those three snapshots are really, really good. So I'm excited to go through this report with you. I'm really interested. I was a landlord, one home, but now I have just sold my home that I was living in and actually moved into my rental property. And I've been churning over what to do over the next few years and kind of want to see what, this report says for now and maybe some projections, hopefully.
Yeah. So you're renting a home as well?
No, I'm living in my rental. What used to be
you're living in your rental.
Yes. I've owned the house for 2 decades, but I need to do a lot of work to it. There was some fire damage in there at one point. So I said, you know what? The housing market is amazing. Let's sell the house. It's too big for us now because my kids are out of the house. We're going to move there and I can work on this and get it ready and let the market cool down, right? I didn't have to buy a house in this market. Yeah. I already owned this one. So that was the whole plan, is get into this one and wait this storm out of, let the housing market go down a little bit. So I'm really going to rely on you to tell me when that is.
Yeah. I mean, because it is very relevant given the evolution of this kind of the single family renter marketplace and the fact that it does have an actual impact at this point on single family home sales for people who are trying to live in them. So I think there's a lot to potentially unpack here.
All right. So give me a little bit more background on why you guys started to do this report. I mean, obviously you look at all sorts of investment property, but why specifically did you start this in 2019?
So we started this one because, I mean, I think just building kind of off of what we were just talking about. Historically, single family rentals were a market that was not something that institutional kind of investors, your big entities of any sort, operated in. Single family rentals were primarily just people who maybe had a second house or maybe a couple houses, mom and pop, kind of like a mom and pop business. Somebody had maybe even built a tiny portfolio, but nothing very big, and it was just kind of often, and it was, so there's always been a single family rental market, but it was entirely populated by that. In the past decade, basically coming out of the financial crisis, is we saw the emergence of this sector. And for a while it was kind of like still a fringe thing. I mean, the big pioneers in this space were a couple of large private equity funds who were, and partly because the laws enabled that. There was an important, I don't remember the exact statute, but there was a law that changed that allowed investors to start buying portfolios of foreclosed homes, as opposed to having to bid on them on a one by one. But since they could suddenly buy entire portfolios, that created created like economies of scale, and suddenly opened the door for this new group. So like some investors saw an opportunity, came in, bought swaths of houses that were foreclosed during the last crisis, and basically created the sector. And then from that, they a bunch of them spun off publicly traded REITs, Invitation Homes, American Homes for Rent. There's a number of them that are now publicly traded companies that you can invest in, that operate portfolios. They become the other thing that I think changed, in addition to the fact that they could assemble these portfolios more cost effectively, is technology. They could create portfolios that were in a small enough geography, and using also just better technology, they can manage the portfolios, like actively property managed portfolios, much better than they than would have been possible previously. So the efficiencies in terms of assembling the portfolios and managing the portfolio suddenly creates this new institutional real estate class. So that's like a long backstory. And then finally, so like some of these other sectors, like the main food groups in commercial real estate, like multifamily, industrial, retail, office, we've done annual surveys on for 7 or 8 years. But finally, in 2019, we thought it was time, just given the growth of this market, to start gauging sentiment around it. And just to give like a sense of how much it does shape the overall single family home market is, I mean, recent months, there have been estimates that up to 25% of the inventory of for sale homes is being acquired by the for rental investors. And in addition to that, you've got alongside of that, they have even started doing what's called build for rent, essentially building entire subdivisions of houses which is not new. Subdivisions of houses are clearly something that have always been built, but the difference is that they're not built for the for sale market. They are built from the get-go to be rental properties. So
wow.
So we just wanted to gauge all of this.
Yeah. The crazy thing is, I had a flashback. You and I have been doing this podcast for a very long time. You've been reporting this for a very, very long time. And as you said that and started to speak about that, I had a flashback to a conversation you and I had a couple of years ago, I believe, about Detroit. And there was this huge hubbub. Is that a good word to use? Hubbub? Yeah. A huge, huge hubbub, because there were a ton of foreclosed on homes, and people, average families, were going there excited to be able to buy a home at a very, very reduced price. They were. I think the city was actually the ones getting rid of these houses, and somebody came in and bought them all. It was one group, right, that came in and bought them all. For whatever reason they were doing it, obviously probably to refurbish some or just get the property for others. But I remember there was a huge issue because single families were like, wait, this was my opportunity to finally own a home. Yes, I know I have to put work into it, but come on, now one person, you made a deal with the city or the state or however that worked and got them all. That
Yeah.
doesn't seem right. So I think this is incredibly relevant, and obviously we've been seeing it. And I don't want to plant seeds of whatever, but I've also heard from a couple different things like Zillow
Hmm.
may have a hand in purchasing homes and and driving some prices and doing rentals. I don't know, but I
Yeah,
don't know if that's
the Zillow situation is a little different, although it is also been distortive to the market. I think they are what's called an iBuyer,
mm,
that essentially they were like trying to buy homes to flip, but like on a large scale.
got it.
And so it is again it is related in a way because it's a way to invest in single family homes that's different from just buying it as your primary residence. It's like
Hmm.
it's like basic creating like an almost an intermediary in that process where they were jumping in quickly, buying homes that were on the market and then trying to flip them essentially. But they got something was, I don't remember, like we had some stories posted to our site about it. I'm forgetting some of the exact details. Either there was something wrong with their algorithm or they were too aggressive, but they ended up buying too many
Mm.
this way. And so then they had to stop and they had to like kind of work through their inventory, and it caused them some losses.
Wow.
But anyway, the point is that's the dynamic of a of what's called an iBuyer, as opposed to somebody that's buying in order to
To
operate the
rent.
house as a rental,
Got it.
because they were not removing. But it just, again, it created this distortive effect, because rather than having like a marketplace that's just you know residents buy from residents, whether that's for a primary home or a secondary home, you've got these people that are trying to create an investment thesis off of that. I mean, obviously that's also, again, it existed on a small scale for years because you have house flippers and
Hmm.
fix and flips, and like lots of people just do that as a matter of course, buying a house and fixing it up and flipping it on the market. But again, that used to be like sort of an individual investor play. Suddenly we have like institutions kind of trying to do the same thing.
Yeah. Well, let's dive into the research. What are some of
Yeah.
the high level takeaways from what you guys found?
So I think one of the top takeaways is that despite some of the tumultuousness that we've had in the broad macroeconomic environment, cap rates on this sector have steadily ticked down in the 3 times that we conducted the survey. People said that average cap rates were around 6% in 2019. In this year's survey, that number had dropped to 5.6%. In addition, the number of respondents who said that the cap rates are actually below 4.5% jumped to 15.6%. So almost 1 in 6 respondents said that cap rates are actually below 4.5% on these assets, whereas the number was about half of that in our initial survey. So
Mm.
I think just any way you kind of just look at that, the high level picture on sentiment around cap rates, it's measured cap rate compression, which is not a surprise. That's definitely something that we've seen in the marketplace. It's just it just confirms that that's happened. However, I should also be not terribly surprising, given that interest rates are rising, and there is a pretty generally stable relationship between interest rates and cap rates. When interest rates go up, cap rates tend to go up, because there's usually like a risk spread between those two numbers that measures the difference in risk between a treasury, 10-year treasuries, and the inherent risk in whatever real estate asset class that we're talking about. So given that there's because there's usually a spread when interest rates go up, it ticks up cap rates. So therefore, expectations are almost 80% of respondents do expect cap rates to rise further this year. And but also interestingly, 20% of people expect them to decrease. So it's almost like a 4-to-1 split, but it's just like an interesting sentiment that, yeah, by far the consensus is, just given a higher interest rate environment, cap rates are likely to go up. But there's a significant number of contrarians, And I think what's also interesting is that there's been this dynamic for years in commercial real estate of, cap rates have been going down year after year after year. And there's generally been like every time one of the things we usually find is whenever we ask this question, everyone's like, cap rates are going up over the next 12 months. And the majority has usually been wrong about that, because 63% of people in 2019 said they thought cap rates were going to go up, and of course cap rates went down. In 2020, in the middle of the recession, 59%, middle of the pandemic, 59% said they thought cap rates would go up, and of course they went down. So there's been some stickiness, even like despite people seeing cap rates being so low, and for such a long period of time, they have to go up at some point, but they've been very resistant to that. I think though, maybe we'll see if the 80% is wrong or right this time. I tend to think they probably will be right this time, just given what we know about the fact that interest rates are going to be raised so aggressively throughout this year. And for cap rates to not go up, that risks premium would have to disappear, and that's not likely to happen.
Yeah. Well, that's a much larger percentage than the last couple of years, right?
Yeah.
80, almost 82, right? That's
about 80. Yeah.
Yeah, that's a good chunk. My goodness.
Yeah. So that's pretty, yeah. So like, whereas in the past it was like more of like a 60-30 split or 60. Yeah. This time it's 80-20.
Wow. All right. What else do we need to know?
In terms of the intentions, we also like to ask, because we are surveying people. One of the when you come into the survey, we ask to make sure you're actually an investor in the space, and if you're not, you get kicked out of the survey. So we are talking about people who do actually play in this sector. We ask them what their intentions are, whether they plan to buy, hold, or sell in the next 12 months, and the big number this year was for holding. 59% expect to hold. Only 29% said they expect to buy. Only 12% expect to sell. So by and large, people they have their portfolios. I think just given the context I was just talking about, that there is a little bit less bullishness about continuing to buy more properties in the sector right now. I think the comparison is in 2020, the number that said they were going to buy was like 43%. So it was 14 percentage points higher the last time we did the survey.
Yeah. I know that you guys can't send out a survey every month, and I'm not asking for that, David, but I am really curious from, March of this year, month by month, how that number would change.
Yeah.
Because I mentioned earlier that we just sold a home. We sold it in mid-April, and within 4 hours of it being on the MLS and on Zillow, we had an offer, a very aggressive offer, which was nice. However, we could tell that it was an investor. We could tell that it was somebody that was investing, because they said, we don't want you to show it to anybody else. We want an answer in 2 hours.
Oh, wow.
And so we kind of hemmed and hawed about it, and we did decline that offer. But I'm curious. It surprises me seeing the writing on the wall with the interest rates doing what they're doing. I'm surprised it's still as aggressive as it is right now. And maybe they're just trying to beat it out. I don't know.
Yeah. And I think, we asked that we conducted this survey more like, the past month or so. So I think to your point, if we had asked that question in March, before the Fed really, before the Fed, I think there was always some sentiment that they were going to increase rates, but nobody was sure how aggressive. And I think now we know it's more aggressive, that number very well could have been higher, back in March when you're talking about, than it is right now. I think, part of the intention of the Fed is to cool things off a bit. And I think that could be what you're seeing in that response that we got versus what we may have seen in March.
Yeah. And I feel like it's almost like a merry-go-round that is being spun really quick. And so every time the interest rate hikes, right, every time they raise it, it's like they've sped up the merry-go-round, and a couple more people fly off, right?
Yeah, right.
Those investors are like, nope, I'm done. I'm out.
Right,
I got to get off. So it'll be, like I said, it'll be interesting to see that over the next, next year, I suppose, because I think we only know so far what they're going to do to the end of this year, right? As far as raising it, we don't
Yeah,
know what to do
and
next year.
we have a general idea that they said they're going to raise rates, whatever, I forget, a certain number of times, and
Mhm.
I mean they could always change that too, but at least to this point we have that process has definitely begun.
Yeah. Wow. Was there anything that was like unusual that jumped out at you in the results?
Yeah, one thing here, I think, just even related to this last question is, we had a second question we asked that's kind of meant to gauge the investor sentiment is what do people expect in terms of investment sales volume for the sector over the next year? And I think the picture we got is that nobody has any real clue.
Well, yeah, yeah.
Yeah, because like basically we got like an almost exact 30-30-30 split between people who said it would rise, people who said the volume would stay flat, and people who said it would fall, and then another 12% said they like literally said they don't know. But I think just like my reaction to that number is just okay, people don't know.
Yeah. Yeah.
Versus in 2019 it was very clear people thought, like, it was over 70% thought the volume would rise or at least remain flat. In 2020 it was 65% that thought it would rise or remain flat. There were some that thought it would fall, but again, we're in the middle of the recession, so there's still a little bit of uncertainty, but I think it was still clearly a little more bullish. This time it's like 33, 29, 26, which to me, just given the overall size of the survey, just like there's no, that's close enough, those numbers, to just indicate that people don't really know what to expect. So I thought that was a particularly interesting finding. Another one was, like I mentioned earlier, we there's this dynamic of build to rent development, and we ask how whether people thought that current level is, basically we're trying to measure whether or not people think there's going to be overbuilding or not. And not terribly surprising, the sentiment's pretty clear that people don't think that there's too much of this development happening right now. 30% said the right amount, 33% said too little. So that's about 64% that are clearly on the side of, things are where we're doing, we're not overheating what we're building there. Only 18% said too much. And then we got a fairly big number though of 18% said they're not sure. So I think that picture to me says it's not like ironclad certainty, but it's pretty clear, pretty solid answer that people don't think that there's a risk of overdevelopment occurring even with a lot of the build to rent that's happening, just given the overall demand for these rental units.
Let me ask you this. I'm really curious because we're looking at our future, right? And like I said, the plan for us is to live in this house for 3 years and then either sell this house and take the proceeds from both and buy a final home, if you want. I'm using air quotes on a podcast, a long-term home where we, a little bit of property or whatever. But my thought is, my concern is, will the supply chain issues be an issue in 2 to 3 years if I'm going to be looking to build? And so looking at it right now, are you surprised by how many of these? I'd never heard of a build to rent construction community. I've never heard of that before. Are you surprised at the increase or how much it's being done right now with the supply chain issues and the prices of products?
I think it just speaks to the fact that, like, overall rents for single family rental, I think went up like almost 10%, pretty much nationally, across the board over the past 12 months. That's a pretty good, maybe even more. I mean, so given that pace of rental growth, which is even faster than the rate of overall inflation, that I think is a big reason why that helps offset any supply chain costs or delays and keeps people pretty bullish. I think also there's just like a deficit of affordable supply in a lot of not just of homes but rentals, and in general there's just a lot of people looking. There's just heavy demand for rental, and I think that's created both by just generations that are not ready for home ownership, and also some people who have looked at the housing market in the past year, and it was a little bit too crazy, so they just decided to rent a bit more. So all of this creates just a strong underpinning demand for rental, which means it's pretty safe to keep introducing new products in that development chain, even if they are experiencing some of those things which they are experiencing, things you're talking about. I mean, labor costs, supply costs, those things are clearly affecting their overall costs, but I think not enough to make the project, not enough to damage the profitability that they expect out of the project, just given where rents are. And even if they expect rental growth to moderate a bit, I don't think anybody expects rents to just keep rising 10% on a year-over-year basis. I'm sure that'll moderate a bit, but just nobody thinks rent's going to fall. Nobody thinks demand's going to fall. So that's giving people a pretty strong basis to build.
Yeah, and I'm a disclaimer here. I am not an economist by any means. I just don't. My fear is that that's not sustainable, right? That charging that much rent or having that much in rent. With, again, labor and everything else, it scares me a little bit, David. I'll be honest with you. I get concerned, but then again, I'm not an economist, and I'm not playing in this sandbox. So
yeah, I mean, I don't think 10% annual rent increases are sustainable for most Americans who are renters. So I think there's still some noise in the numbers too, because there was at least some period where rents went down a little bit or stagnated during COVID and then suddenly accelerated. I mean, like New York markets, like the New York market I like, which I'm again going to have to enter, is a bit baffling right now to me too, because there are all these conflicting numbers. There's like the New York City population is declining. So you would think that would create more opportunities, but instead rents, which fell like pretty significantly at one point during COVID, which is just not something that ever happened in my entire time living in New York. They fully came back to pre-pandemic levels and now are hitting new highs. And it's like, so we have a declining population, but somehow rents are going crazy. But then there's these other factors such as the amount of units in New York that are being held for sale, like rather than for rent. I mean, obviously we don't have single family rental in New York, but we just have rental. But you know, there are a lot of people that just buy residential as an investment, even if they don't live in it. Buy a condo unit. It's a tax shelter. They do all sorts of people do that. International investors do that. It's a way of, there's currency hedges, there's inflation hedges, there's all sorts of reasons, but like that takes supply off the market. There was a report recently that the inventory of Airbnb units is now larger than the inventory of rental units in New York City. So, and I think that's something that other cities have run into too. Like that, none of this, I feel like these are not good things and things that would need to be addressed for people to have basic affordability. And I don't really understand how New York had gotten to the point where like Airbnb is that unregulated, to be honest.
David, this has been fantastic. I know I've taken a lot of your time today, and you've taught me a ton as usual. But can you kind of tell the audience some of the other things that they can find in the report and where to find it as we wrap up?
Yeah, so it's on wealthmanagement.com in the real estate section, the WMRE section. If you just go to the main website and click on that, you'll find it. We have a research report section, so the write-up is there. In addition to our other research reports, which I mentioned and cover some of the major property type food groups, we also do an annual one on seniors housing that we'll be publishing fairly soon, one on net lease investment that we published earlier this year, a number of other ones, but we'll probably have over 10 of those reports this year. Within this specific report, we also like stuff that we didn't talk about because I don't want to just keep throwing numbers at everybody, but there's questions about where people expect occupancy rates to go, questions about the state of capital markets and how widely available debt and equity are, what people expect for loan terms, and we do even ask people what they expect for interest rates and the risk premium and that kind of stuff. So there's lots of other additional data points that are, well, some of those might I think a lot of them are in this brief write-up. We also will do some of that stuff which may not be in that report would be part of a longer write-up that we would do later in the year, which would feature more of these charts as well. Like for this one, we only did like one little chart to just as kind of a teaser, just to get the report published. But yeah, that's kind of about it. And I guess, and if there's any landlords in New York looking for a tenant, you could also hit me up around that.
There you go. I was just going to say, I would love to. Well, first of all, I'm wishing you the best of luck in your search, but maybe this is an opportunity to do a small documentary on finding a place to rent in New York, in 2022. Might make a good article. That'll be interesting. I hope it's not a heartbreaking article.
Yeah.
Got to be good. All right, Dave. Well, thank you so much for your time again.
All right. Thank you. Have a good one.
And of course, our last thank you goes to you, listening audience. Thank you so much for tuning in and listening to the Common Area Podcast with David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. This makes it really easy to share these podcasts with your colleagues. Again, thanks for listening today. For everyone at WMRE, this is Eric Johnson inviting you back in 2 weeks for all the stories that matter to you. And we'll talk to you soon.
Thank you for listening to the Common Area Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of WMRE or Informa. The content has been made available for informational and educational purposes only.